Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting. Welcome to Charts and Chat for July 12th of 2026. We start off the chart pack this week. Let's talk about business cycles. This is a very good chart from Deutsche Bank. Very robust data set that goes all the way back to 1854. So some terrific informative power from this particular slide. And the crux to this is, believe it or not, as we sit here today, after the pandemic, we are officially in the sixth longest expansion economically in U.S. history. And of course, prior to the pandemic, we established the record for the longest expansion, which was over 10 years. And you can see, very interestingly enough, after the peak in inflation in the early 80s, that we have tended to have longer economic cycles that really kind of well exceed the average of roughly about 42 months here. And of course, these data sets, when you go back, basically a century, and you go back, literally about 100 years here, that the business cycles were not that long, and you tended to have more interruptions to that, where you have you have a recession, and then you build back out of it, and you tended to have more frequent business cycles, as you could very well see here. But they have gotten longer over time, and as the old adage says, that they typically, these cycles don't end because of old age. They typically end because of some policy error, some policy mistake, some political agenda, whether it's on the fiscal side, or you make a monetary policy mistake where you don't read the right signals, or you read the right signals wrongly. They call that a type 1 or type 2 error. But in any case, a long business cycle here that we can all celebrate. Now we talk about AI-related inputs into economic growth. This is another good slide, goes back to 2022. Gives us a sense of what has led us to this point, because as we know, AI as a theme has been a very strong driving force behind economic growth. Obviously, if we did not have this AI impetus, that our growth rates would be much lower. You can see here the drivers really over the last year. You can see here information processing equipment, software, and to a lesser extent, you've got data centers and power facilities offset by net trade of AI hardware down here. And looking ahead, this is dotted line here represents where we are today. It represents what economists, at least their best guess at this point, as to what those drivers are going to look like as we look into the next several years. And as you can see here, a lot of consistency. So a lot of the same things that have led us to this point are expected to continue. So from that standpoint, if these estimates hold true, then that consistent investment will definitely be a tailwind to economic growth. Now we look at a chart that kind of gives us some data that we've seen in other ways before. It's kind of like this K-shaped economy. We'll have some comments on that. But this is essentially personal outlays, or what we call consumption by income group since the pandemic. And again, we've talked about this in the past, how the upper income cohorts have supported consumption. You can very much see that right here, that line is, started off, at this, this common point back in 2020, and you can see it's continued to separate from these other income groups here. Middle income and lower income, as we most certainly know, have been much more impacted by the cost of goods in the supermarket, gasoline, so on and so forth, cost of insurance. All of this stuff has weighed much more heavily on those lower income cohorts. And again, the economy, at least from a consumption standpoint, is very well supported, at least for the time being, from high income earners. Now we talk about the bottom half of the population, and I think this is important as we look at credit quality, we look at credit metrics to see, are we heading into some type of economic cliff here, at least from a credit standpoint. You can see here the subprime loan delinquency rate, and of course that peaked in the global financial crisis. There were a lot of loans back then that should never have been written. They called them liar loans, no documentation loans, so on and so forth. Anyway, the industry has learned a lot since then. However, we saw that credit quality, by and large, improved considerably. And then, of course, we had a forbearance here. We had, the virus moratoriums on, we had all sorts of forbearances that were in place during the pandemic. But we can see here now that those delinquencies are rising again. And again, these are for people that have very low credit scores, and they're probably paying very high interest rates, because that is the price at which the lenders are going to feel like they're going to have a return on investment given the higher risk that is being borne by these loans. And you can see here, this would be kind of this line, I'll call it, is the line of best fit, around 10% of loans outstanding. So, and this has proven to be somewhat linear. So call this a trough. We're certainly not where, we were leading up to and coming out of the global financial crisis. But this is something we clearly need to monitor going forward. Look at consumer loan interest rates. This is also something that we pay attention to because, this is an input into that credit equation. You talk about affordability and you talk about wherewithal to make these payments, and that all leads into the whole credit evaluation there. And you can see credit card loans peaked here about 22%. They have come down a little bit, which is interesting because interest rates overall have meandered a little bit higher. You can see here that personal loans have kind of held steady. We'll call it, maybe 12.5% here. And then you can see here on new car loans, those have come down. So, at least they're not moving higher at this point. So, this gives us some window into the thinking on the part of lenders on how they price risk. If these rates are not moving higher, then we hope that they're not seeing those types of delinquencies that we saw on that last chart, which would otherwise cause me as a lender to want to raise these rates to be compensated for it. But right now, that's not the case. So this is a chart that I think does speak to the K-shaped economy. And again, you got the green line represents the top 20% of the income group. And the bottom 80% is represented by the blue line here. And this data series is a share of personal outlays by that group. And so again, confirms what we saw in the earlier chart. You've got the upper income folks that are really driving the boat, and you've got the bottom 80% that are lagging. And within that bottom 80% is really the bottom 50%. You've got the people in middle incomes that are kind of holding steady, as we saw in that last chart. They're not, maybe they're growing a little bit, but they're certainly not growing like the upper 20 is. But the bottom 50%, they're really struggling right now. Now we'll talk about the wealth effect. We have another terrific data set here from Bureau of Economic Analysis, Moody's Analytics, and the Federal Reserve. Data series goes back to 1950. You can see here, this is the actual ratio of household net worth to disposable income. So this is really the wealth effect in its purest form. Of course, we've got the internet bubble here and the housing bubble here that posted very notable peaks where we had some significant offsets to that. But let's just take a line, an imaginary line, and put it right here. So that's 2010. So 2010 now gives us a good solid 15 years of data, and you can see that this is not quite parabolic. But if you go all the way back here, again, 1950, we have not seen a sustained growth rate of this magnitude at any point in that history, in that post-World War II period. This is, one of the most interesting things when you look at household net worth and incomes, and real incomes at points in time have been negative or been stagnant or even marginally positive, but not robustly positive. But yet, households have managed their debt loads very well coming out of the housing bubble. Of course, now more households own stock, so the wealth effect has been generated that way. Obviously, they own houses. The house, home price appreciation has factored into this. So there are other inputs, but this is probably one of the more compelling data points in all of economics right now, looking at and over the last 10 to 15 years. So another slide here talking about the wealth effect. We've got the annualized GDP growth driven by changes in household wealth as a percentage. And you can see here moving higher, again, more confirmation. This indicates that by and large we have remained positive here for, going back to essentially 1995. But, household wealth has been a consistently positive influence on overall economic growth. So in this conversation of wealth effect, obviously there's a lot of different drivers for wealth. Income and savings is something that it does factor into that. You can see here in a time series, it doesn't really go back that far, but it's really more the trend and the inflection that I think matters in how we interpret this, is the fact that personal savings rate continues to move lower. At a time where we have struggled with kind of our outlook with the economy, maybe it's going to slow down. In effect, it really has, but it hasn't stagnated like perhaps a lot of people thought it might. In light of the tariffs and so on and so forth, that really hadn't happened. But how we are sustaining this growth is interesting, because it is sustained through consumption and spending, and you can see here that we're spending into our savings rate. We're not saving, and some of this is driven by inflation and tariffs and higher energy costs and higher insurance and higher cost of everything that relates to a home maintenance, improvement, things like that. But you see here, real after-tax income growth has stalled at the same time that we're digging into our savings. And so as really you take January as this demarcation point, and everything prior to January was, at least from a after-tax income growth on a real basis, was not bad. But savings rates were coming down at that point. But it's really since January that we've taken really strong note of what the dynamics are here, especially with this big drop back in April. Of course, it is now July, and so we're going to be getting some more of this data, over the coming months, certainly for the second quarter, and this is going to be something that we're going to pay a lot of attention to. So now we talk about the puts and takes, at least as it relates to income and consumption, and we were spending a lot of time at the beginning of the year talking about the OBBBA and those tax cuts and what it means for consumers and putting more money into people's pockets and giving them larger refunds, and that was all true, but we didn't anticipate that we were going to be in a bombing campaign with the Persian Empire over there in the Middle East, which has increased energy spending, which interestingly enough, and even more so last month than April, when all of this really started, is that all of those gains have been offset. And so, we don't necessarily feel any better, right? And so all the effort and the jawboning and the press that was related to the tax relief that's represented in the blue, and that's real tax relief. So, make no mistake, the OBBBA did provide benefits, but they've been soaked up. when you look at the big picture. So I want to take a moment now and step back for a minute, and as we sit here in the middle of the year, what are the drivers of the year? Now, some of this may seem very intuitive to all of you. Some of this may not, in fact. But as we look at these drivers, obviously AI spending. We've talked about this a lot. You can see here in this chart from Apollo, it really sums it up. There are three main drivers, right? I mean, we've talked about AI spending, data center spending, and now that's leading to a lot of political headaches, as we've got jurisdictions that don't want these things in their backyard. You've got energy spending, which is more of an infrastructure play, and that's a real thing. We're going to talk about that a little bit too. And the productivity gains from AI. Now, there's a big debate. When does that come? And I think there's a strong argument to be made that we're going to have to spend more to get to that point, and that's going to cause it's going to cause margins to drop before they get better from the productivity gains. So a lot of themes and a lot of discussion around these three subpoints here. But AI spending, make no mistake, it's a huge driver. We just talked about it in some of the preceding slides. That's real, and that's a multi-year phenomenon. That's not going to go away in the third quarter or the beginning of 27. I mean, this is a sustaining impact. Now, how it plays out with all of the political undertones, we'll just have to wait and see. Now, in addition to that, we have this industrial renaissance, and of course, coming off the CHIPS Act and a lot of the domestic onshoring of semiconductor production. We know that we're going to need a lot of chips. I mean, you just look at the share price of Micron and their demand backlog that will confirm that even the most, I'll call them staid semiconductor players like Micron, they made dynamic random access memory, or DRAMs, and that was the most commoditized semiconductor that could be produced. But now it's in the highest demand because you need them for data centers. And then these other two categories, which are maybe a little bit more salient with all the press that's going on around AI and all the derivative spending around that, pharmaceuticals, need to onshore that because a lot of these drugs are made overseas, particularly in China, where we don't want to have that dependency, and then defense for a lot of obvious reasons. And not just the U.S., but with the U.S. kind of pulling back a bit on its support of these multinational defense consortiums like NATO, you've got more defense spending overseas by these foreign governments as a percent of their GDP. So, you've got semiconductors, which pretty well understood. Obviously, the chip sector has done very well this year, but then these other more salient areas that have also witnessed a lot of growth and are going to be contributors to growth for a while. And we just got through talking about the one big beautiful bill. Again, benefits there. That has certainly helped our growth, but as we just saw, higher energy costs due to the Iranian conflict have unfortunately largely offset that. But there are benefits to businesses rather, as well as taxpayers. So you do have a lower tax base, at least for the time being. Of course, again, laws can change. It does have incentives for businesses in terms of immediate expensing, lowers your income, obviously lowers your tax liability as a result, and then also infrastructure and defense spending incentives therein. So I spent a lot of time on this chart, but I think it's really important to kind of talk through these things because these are the things that are really driving our economy right now. It's a good chart here. After many years of kind of a manufacturing recession, it's kind of the so-called rolling recession that we saw, even though we didn't go into a full economic recession. It's really good to see here that we've got some expansion in capacity. We just got through talking about a lot of the infrastructure things and then obviously technology spending that's going to have to take place. And so, you can see here going back to the trough in 2022 that we've been expanding that capacity ever since. And again, we know why, and this is definitely going to be a benefit to the economy, even though manufacturing is less important than services overall. That this is the mark of an expanding economy, which I think this will continue to rise as we move into 2027 and 2028. Now, I want to spend a little bit of time on a relationship that I think is really not only interesting, but I think it's also important. And I think it does inform us on some things related to the prospects for future growth. And so I want to spend just a couple minutes on this. So on this left side, we have a plot of the ISM manufacturing PMI against the Philadelphia Stock Exchange index for semiconductors. And so again, so let's just look at it like on its face. It's a plot of chip prices against manufacturing PMI. And as you can see here in a data series going back to just before the beginning of the century, 1998, there's actually a really strong relationship here, and that prices for semiconductor companies, is actually a leading indicator. And you talk about the relationship of one data series to the next, and if we were only talking about a couple of years, you might be a little bit more skeptical of this relationship, but it's actually held true. And so when you see prices rise, and again, we spent a lot of time over the last couple of months talking about this meteoric rise in chip stock prices, that it tends to be a leading indicator for future investment. And so you can see the shoots of that right here, right? And so this has the prospect. Again, I'm not getting too carried away, because I do think semiconductor prices have moved almost too far too fast. Again, not that it hasn't happened before, but let's just not get overly optimistic yet. But I think there is a prospect of this ISM manufacturing index moving higher, much more solidly in expansionary territory. And if you track over here to the right, you can see that faith is being put into motion already, and you got basically infrastructure investment that is in fact playing out like this would indicate that it should. Let's talk about data centers now. Part of that investment in facilities and plant and equipment and capacity and everything that we've been talking about in these last few slides. Let's look at the number of data centers here existing. We've got basically over 4,000 data centers, and this is the hubbub, right? A lot of new construction is planned, and that's why we've got these hyperscalers that are taking down a lot of debt to support this expansion. There's a lot of speculation now because free cash flow is declining and they're taking on new debt. Is this sustainable? Is it going to break at some point? But I think one thing that's important to look at over here on the right is the fact that while there's a lot of planned construction here, I don't think people are getting too carried away, because we see the rate of growth is declining. And I think that's actually, to me, it's a reassuring sign that this is not getting out of control. Now, again, we talked a little bit, in a prior slide here about some of the political headwinds, that cities and, even here in Texas, the governor doesn't want some of these data centers in the rural areas. And then you've got other towns that are trying to impose zoning limits on these things. And so there's a lot of cross currents going on right now. But suffice it to say that, there's still a lot of planned development. We're going to need these data centers to support, the token growth that we see in all these LLMs, but the rate of growth slowing down, I think, to me is fairly reassuring. So capital spending as it relates to AI, again, expectations are pretty high, whether it relates to equipment or facilities. We just got through talking about facilities, but let's just take it for what it's worth right now. that capital spending, through all of these hyperscalers is expected to, to continue to go up over time. And again, going back to that slide about what are the drivers for the economy related to AI. Well, obviously, there's a lot of capital spending here, and it's going to be impactful on our economic growth. Now, one thing I do want to spend a second on, and this was a slide in Apollo that I really took note of. So, we talk a lot about token growth and expansion of these and evolution of these large generative models. But make no mistake, China, they might be a few months behind us, but you can see that the models that the Chinese are putting out there are getting market share. And so, we have a pretty strong global competition on our hands. And, interestingly enough, we went back to the beginning of last year and you saw France, Canada, in the mix here. And really right now it's a two-horse race, but, I think, there's a competitive impetus to all of this that I think may not be as well understood, that the Chinese are nipping at our heels here on these models, and that is causing a lot of, spurring a lot of investment and a lot of research and development. So I want to take a step back from the AI investment picture and just talk about infrastructure in general. And this slide really speaks to that. Again, another great slide from Apollo. Torsten Slok there does a phenomenal job, and his research is really spot on with some of these issues. And so this chart, just shows you, basically, breaking this down into highways and streets and power infrastructure, and the fact that the average age continues to rise. And this is measured in terms of years. And you go back to, beginning, let's just call it the beginning of the century here. So we're, call that about 27, 28 years. Now average age is about 34 years of all these infrastructure, of these two main infrastructure components, that we're going to have to update these. We're going to have to replace these. I mean, so this is not just an AI story. This is core infrastructure. You can put bridges in that line item too. I mean, we have a growing number of bridges that are now deemed to have some structural incapabilities, given the rates of traffic that are on some of these things. So this type of spending and this need is 100% real, and it's going to demand some additional investment well beyond what we're going to be spending on AI. Moving on from AI into kind of some other economic data points here before we get into equities and fixed income. Here we have continuing jobless claims. So this is not the initial jobless claim that we get every week, but these are the continuing claims. And we can see here labor market that is in, kind of a weird place right now, as we've talked about over the last several weeks. You're certainly down from the peaks, the interim peaks that we've seen here over the last 18 months, but we have now seen a bit of a trough, and we're seeing those continuing claims pick up just a little bit. This is a very profound chart, in my opinion, and something that actually, when you think about it, makes a lot of sense. So we've talked a lot about the hyperscalers and capital spending. We've talked a lot about the need for growth and to support the expansion of AI, and of course we've also reflected on the tremendous growth in the semiconductor companies this year. We talked even as recently as last week about Micron and how their backlog has literally exploded. But in this chart, it's very interesting. So we see at a point where free cash flow of the hyperscalers is dropping. Now, we have talked about that, right? That's some of the concern. They're wanting to spend a lot of money, but free cash flow is dropping. Well, where is all that spending going? Well, guess what? It's going into what I'll call that next derivative or that second derivative spending, and that's all the semiconductor companies. So you see, while the hyperscalers are witnessing declining free cash flow, the chip companies are seeing that their free cash flow explode. And this is like almost as this is inferring from B of A research, a generational transfer of kind of a wealth, if you will, from one part of the market, from basically the buyers to what I'll call the sellers, the semiconductor companies. Again, we haven't seen this kind. This is extremely rare to see that kind of inflection. And we had this chart, about 3-4 weeks ago, and it's every bit as true now as it was back then. In fact, if anything, the delta, the difference has grown greater in this data series. And let's go back to basically the beginnings of the Iranian conflict, right? I mean, we had rates that were low, they were meandering lower. Inflation was largely kind of in control, even though it was stubbornly a little bit higher than where we wanted it and where the Fed wanted it. And then all of a sudden, then we had the Iranian conflict, and then energy prices went up. Necessarily, as they do whenever you have a conflict that might impact the energy markets, and they stayed higher for a while, but energy prices have come down. Granted, as I'm recording this, the ceasefire is off, and people are bombing and sending drones, across the Strait of Hormuz now, and the Iranians now, say it's closed and all that. But anyway, news flow can change daily, but by and large, crude prices have gone down. However, the other side of the coin, with interest rates moving higher on the fears of a prolonged conflict and the risk of prolonged higher energy prices influencing a trend higher in inflation, that side of it hasn't changed. 2-year yields have only gone up at the same time that this supposed reason why these interest rates might move up, i.e. energy, those prices have come down. So we've got an increased risk parameter that's being built into the shorter term yield markets. That, coupled with the fact that of course we're talking about 2-year yields here, but the fact is that we're talking about the potential for rate increases at the very short end, which would obviously play into 2-year yields to some degree. But again, this is a very odd divergence here. You would have thought that these would have dovetailed a little bit more closely, but it's clear that interest rates are being influenced by other things rather than just the energy issue. I've got a private equity slide here. This just shows you the number of private equity-backed companies that are out there. All this, really you should take away from this is the fact that there's persistent difficulty in getting liquidations of these investments. And you think about a private equity firm, they'll make an investment, they'll put investment into the company to increase its value, and then they want to realize that investment and then take that capital, take the proceeds and reinvest it into other companies, and they create a velocity of investment that way. Well, the more companies that you have in your portfolio that you are having trouble getting rid of, the less velocity and turnover that you have as a private equity firm. And that's kind of where we've been over the last 10 years. And so, you've got a rising number of companies, and it's remarkably linear if you look at this chart. And it's just a symptom of the backdrop where, private equity firms have a lot of cash, a lot of capital, a lot of seed corn to invest, but at the same time, they are not getting the liquidations that they want. And usually, in a much more healthier environment, a PE firm will want to, take one of their investments and do an initial public offering. And again, we haven't seen that much of that except for these large mega deals this year. But hopefully that'll change, and we'll begin to see more equity supply coming into the public markets, coming out of the private markets. We'll talk about some of the stock market related items here. I've shown you this chart many, many times. You've got basically the active managers here. Sentiment still kind of holding in there. We've had a lot of volatility in this data series. The 4-week moving average pretty solid here, and I'd say that's a pretty bullish signal. Now coming over to the individual investor sentiment, bearish. Has, again, I call this kind of almost flattish. If you look at the net indicators, we've become maybe a tad bearish, but I think that's only because of valuation. But I mean, really, by and large, I would call this kind of a flat environment. Really not much of a change here in sentiment from the individual investor standpoint. So this is something that it's a real thing as well. So earnings estimates have actually expanded considerably, and this really speaks to that. I mean, this is actually the gap between the forward 12-month earnings expectation for the S&P 500 and a cyclically adjusted 10-year return. So this is basically showing you what the expectations are for the next 12 months relative to the last 10 years of annualized growth. And we haven't seen a data series this high. I mean, this goes back to 1996, and we haven't seen forward earnings expectations that are this disconnected to the rates of growth that we've seen in the past. And so, on its face, it makes you kind of skeptical as like, can this really play out? But I'll tell you, every time over the last 3 to 4 years, if you had been just a massive skeptic on earnings growth, you would have been a loser every time. If you were making that bet that the companies were going to underperform earnings estimates, you would have been wrong every time. In fact, the average beat is only increasing. So, there's a reason why these estimates are going much higher. But it does make you take notice when forward earnings are so incredibly higher than what has been expected in the past, or what been realized in the past. That it just makes you take note. So here we have bottom-up consensus revision. So we just got through talking about the massive gap between forward earnings and historical earnings. This is where we're getting some of these revisions: technology and energy. Probably not a big surprise. Energy prices are higher, and technology is everything that we've been talking about for the last 30 minutes. And then you can see here, again, another iteration of what we just saw in that last chart. This is just forward earnings per share moving higher. And you can see that lately that this forward earnings has become a little bit parabolic. Particularly in the rate of change here. I mean, we've seen basically 30+% growth year over year in these earnings. Again, just amazing. Here we have the forward PE based on those earnings. And for a while, this is kind of a thing where, prices were maybe eking up a little bit, but, earnings growth was so tremendous that the E in the PE ratio was moving faster than prices were. And so you actually had multiple contraction. But as you can see here, we are more than one standard deviation above the average PE ratio. So again, this dotted line, represents 67% of all observances. So we remain in this rarefied area here where, this is something that just, we don't see that often, these valuations. Now, as we look at the difference between the US valuations and global valuations, that gap continues to get wider. Again, I think what this does is it does speak to the merits of international diversification, because international stocks are just plain cheaper than US stocks. But oddly enough, US stocks, have continued, we'll call this multi-year upward glide path in valuation. You can see that more or less depicted here. You can see where international stocks have increased valuation, but just not at the same rate as U.S. stocks. And so you see that valuation gap very pronounced there. Another interesting development as we've seen this, this market expansion over the last several years is the advent of new product. And so, the best way to introduce product is create an ETF, an exchange traded fund. And you can see the number of launches this year has, it's up 55% versus a year ago. And you realize that we have, over 5,000 ETFs. We actually have more exchange traded funds than we do have publicly traded firms that are listed on the index. And that's, we talked about that several weeks ago, and that's just a very odd occurrence, but that's the trend. And, the risk there is that you have all these ETFs that are having to buy the same stocks that are, and you have more ETFs and more ETFs that need to buy the same stocks. And eventually, you're going to have a crowding in, so to speak, and it's going to drive stock prices higher just because you're going to have so many ETFs that are going to need to buy them. Couple minutes here on fixed income. We do have mortgage rates. Again, you're looking at the mortgage rate here in the black line. That's really kind of holding steady. Again, at this kind of, we'll call it the new normal, somewhere around 6.5%. You've got 10-year bond yields that are moving up just a little bit. We'll call it, basically 4.5%. And again, mortgage rates are closer to 6.5%. Excuse me. They were 6.25% not too long ago. But and then, but the spread between these two has, does vary. And really, mortgage rates are 30-year conventional fixed mortgage rates are benchmarked to the 10-year Treasury. So there is necessarily a relationship there, but we can see that the gap between those is roughly about 200 basis points right now. And we can see here, as we've been talking about, mortgage rates kind of holding steady here, but then the average or the effective rate on all mortgages outstanding continues to rise as more of those prior mortgages are turned over because people move and they have to get new financing and blah blah blah, that average rate continues to move higher. And we'll talk about interest rate policy and the Federal Reserve and, all the things that they're looking at with stubborn, inflation that is probably, not going to go away for a while. And they look at the labor markets and, again, we're kind of this no hire, no fire, phase of the labor market. So what are they going to do? Well, when we talked about this before, the Iranian conflict, I mean, we're expecting multiple rate decreases, and that's pretty much off the table. I mean, that's pretty well understood, so not new news there. But, what has changed and has evolved that even, going from, the last meeting here at, the Federal Reserve and the minutes that have been released, that now we're looking for at least one and maybe even like a 50% probability of having a second rate increase over the next 12 months. Now, the last slide that we have here is something that caught my eye. And again, I'm still kind of conjuring up, really what the implications of this are. China's got a big economy. And they're exerting themselves both militaristically as well as, economically, trying to spread their economic influence to try to undermine the Americans. But there's a lot of things inside of China that are kind of half broken right now. And this is one of them. China home prices are in a negative decline. We've talked a lot about non-residential construction and a lot of vacancies and a lot of properties that were not built well that are now structurally unsound. And there's just a whole bevy of things going on in China internally that are not in particularly great shape. And I just happened to catch this one as one of those, both on the new and the used home price basis that they're seeing an outright deflation in those right now. That's all we have for this week. Hope you've enjoyed the chart pack and have a great week. I'll be out probably for the next couple weeks. Not sure I'll be able to get to charts of the week due to vacations and being out of town. But we'll talk to you again soon. Take care.